It's time to check your money with Mike Jennings. Mike Jennings is a wealth advisor with Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. Mike, how's it going, my friend?
It's going good. It's going good. We almost had a hiccup this week with the central air in my house, but we got
Uh-oh.
that
Oh, no, no,
got that
no, no.
together.
Yeah, yeah,
Yeah,
no, no, no.
that wasn't about to happen.
No, that's not a good thing.
Mm-mm. Nope, baby boy was not having that.
No, and neither were you, so you had to fix that.
Yep, we had to fix that, but it turned out to be fine. Turned out to be fine. So we're doing good. We're doing good. How are you doing, George?
I'm doing good. It's been 1 month, of course, since the Knicks won the championship.
Hmm.
So that's
Hmm.
always good on my mind. And, I'm preparing to take a little trip soon. So we good. We
Oh,
good.
good. Oh, good. I'm sure
Yeah.
we'll hear about that
Oh,
once
you
it.
will. Oh, you will.
Yeah, yes, sir. But for this week, we've spoken on we've spoken about like so many different topics in the last couple weeks, couple months. And since then, we've gotten some updates for some of these stories. So, I figured now would be a good time for another one of our, sort of quick hit segments to sort of get the people out there caught up on some of the things that we've mentioned. Uh,
Mike, before you continue, first of all, I appreciate you doing that because I was actually thinking about you because one of the things that you talked about, I'm sure it's going to be on your list. So I can't wait for you to. One of the things you talked about happened as you predicted last week, and so we'll see if that's one of the things on your quick hit list. We'll
all right.
see.
We'll see. Hopefully it
Okay.
is. Look crazy out here.
I will interject if you are right on point with what I think it should be. So
All
go.
right, all right. Listen, in my credit, it's been a lot going on.
All right.
There's headlines all over the place. So if I miss it, definitely you can definitely bring that up. We'll talk about it.
Okay.
But I mean, like overall, inflation has been a big topic recently, especially with everything going on in the world. And we just had an update to the consumer price index for June. For those out there, quickly, CPI is a measurement, a type of measurement for inflation. It's the consumer price index. Um, it was reported that CPI fell 0.4% for the month of June, which was the biggest monthly drop, I believe, since April 2020, I believe, was the last one. Last biggest drop, monthly drop like that. So that brought annual inflation down to 3.5%, which is below the 3.8% that economists expected. So it did a little better than projected. Again, for those out there, if you remember from our Federal Reserve talk, that target CPI is target inflation is 2% rather. So the core CPI, which takes CPI is like a basket of consumer goods, and it's an index based on that. So there's another sort of specialized form of CPI called the core CPI, which is really what the Federal Reserve sort of looks at, and that excludes food and energy because that could be really volatile. So core CPI was flat on the month, and it is at 2.6% annually. So the underlying sort of price pressure hasn't really cooled nearly as much as a lot of the headlines are suggesting. You've probably seen a lot of headlines that say inflation is cooling, so or seems to be cooling, and you'll definitely see a lot of government representatives sort of spouting that idea as we are still in this war of affordability. Um, and this is following May, which definitely was a scorcher. The headline CPI had surged 0.5% that month alone, and it was at 4.2% year over year for May. So June is definitely a sharp reversal of that, but it's not like a steady trend that we definitely want to see. What this really means, I guess, for our listeners out there is, don't get too excited about just 1 month of data, right? Grocery and everyday costs are still up 3.5% from a year ago. And this cooling, quote unquote, is being driven almost entirely by one category, which is gas, rather than a broad relief from across the basket of goods that people actually want to buy. And speaking of gas, let's get into a little bit what's happening there. George, have you noticed a drop in gas prices?
I have slightly, but
I
it depends on where you
Depends on where you
slightly,
shop. Depends on what
right,
street you're on.
right, exactly.
Yeah,
But
I mean,
under $4 at some
yes.
places.
Yep, we definitely are. So obviously I felt it too slightly. Gas prices dropped overall roughly like 10% in June. And that really was that was the single biggest driver of like this soft inflation headline number. But I mean, gas is still 47% higher than before this whole Iran war began. Um, and that's even after falling 17 cents from its recent peak. So, definitely the cheaper here is definitely relative. Um,
Well, what's interesting is, and we tend to be higher than the
right.
national average, if you notice that.
Oh yeah, yes, yes, yes.
Syracuse, anyway. Yeah.
Yep. Um, but I guess the the update to that update is that this relief on gas prices is now right back into the headlines or right back into risk because we've seen these renewed tensions in over the Strait of Hormuz. Your tanker attacks, this one day we got a ceasefire, next day we don't have a ceasefire, next day we got a ceasefire, next day we don't have a ceasefire. Um, Trump is going crazy on Truth Social. I don't even. I'm getting tired of those screenshots from him. It's a very very surreal state of existence. Just having somebody like this, being like the leader of the quote unquote free world. But this isn't a politics show, but this is a finance show, and that does have a lot to do with politics.
Yeah.
Um,
Especially right now with what you're talking about.
no, absolutely.
Because part of
Um,
that volatility is exactly that sort of
mhm.
all over the
Right.
place
Yeah,
tweeting.
almost direct volatility coming from one person and it's affecting everybody. But th what that means overall for out there. So if you felt relief at the pumps this month, enjoy it, but don't necessarily bank on it lasting longer or for too much longer. Hold off on assuming lower gas prices are here to stay. If you're like budgeting for, summer road trips or maybe some bigger purchases tied to fuel costs. Um, and the Fed is still talking about a rate hike. If that does happen come this fall, you can expect borrowing costs, so credit cards, auto loans, variable rate debt, to tick back up after a certain period of this relative calm that we may be in. So really, inflation is in this uncertain state, and another thing we have to consider is also what that means for our retirees, which we have also spoken about quite a bit the last couple months. So I mean, obviously, energy volatility matters for retirees too. A lot of people out there are still driving. Um, but the thing with inflation, um, when it comes to Social Security is the COLA. So that's the cost of
Cost of
living
living.
adjustment that people can expect every year. So that was estimated at 3.8% for going up for 2027. Um, and that's it's been unchanged from last month's projection. Um, but if you're speaking of the again going back to the specific inflation subsets, so like CPI or CPIW or something like that, which are prices paid by urban wage earners, clerical workers, things like that, measured over a third quarter window. So you know we can see that we still have a volatile few months ahead. Again, including this Hormuz-driven conflict, and that will definitely shape the final number. So don't rely too much on this 3.8% cost of living adjustment for 2027. Especially if you're on a fixed income, if Social Security is like the biggest portion of your retirement income, because these energy prices could spike again, and that could really just tip the scale more to one side than you would like it to be. So our retirees out there definitely shouldn't finalize any sort of 2027 budget numbers based on that COLA. But also, there's another reason to speak on Social Security, and that is that projected insolvency, which we spoke on a few weeks ago, right? So luckily, our update for this week isn't that the timeline has moved up again. Sort of, I guess, is more positive news. This week, there was a bipartisan group of senators that introduced the Promise Act, which stands for Protecting Retirement Opportunities and Maintaining Income Security for Everyone. Congress loves its huge acronyms. So what this act itself doesn't like raise any it doesn't actually put any sort of measure in place. Instead, it sort of directs like this. I believe it creates a bipartisan seven-member Social Security Advisory Board that is being created to monitor this specific situation more than Congress has been doing in the last 100 years. So it's going to be an advisory board to draft a fix for the solvency. It's going to be informed by the public. It's going to, I believe, aim for at least 50 years of solvency. Any measure that they put forward is going to aim for at least 50 years of solvency. And then they're going every 10 years, they're going to issue like some sort of report or something to monitor it. Um, so hopefully, obviously this bill has to go through the regular processes, and reach approval and get signed by the president and things like that. But luckily, there is a bill out there. Well, it's not a bill anymore. It's law that doesn't have to worry about being signed by anybody because it became law regardless of anything else. Is that what you were talking about, George?
Yes,
I
sir.
hope it was because
Yes, sir. Yes,
that's my
yes.
last topic on
Yeah,
here.
yeah, no, because when that happened, and then it's, if he doesn't sign it, it was become law, and it actually did. So, I was like, yeah, Mike told us about that already.
I did. So
Just to
yeah, if
remind
you,
people again what the law was that was supposed was
so it's the 21st Century Road to Housing Act. I believe that's right. Again, these people love Congress loves
acronyms.
their acronyms, and they always want to tie it into some other like big theme or something like that. But yes, the act that we spoke about did go into law without Trump having to sign it, without the sort of pocket veto thing that people were worrying about. Um, it had overwhelming support in Congress, and it was not vetoed after that 10-day constitutional window, so it did become law. So one of the bigger things that people are talking about from the overall bill, because it's huge, one of the bigger things that people are championing is the ban on institutional private equity investors buying up single family homes. Um, and believe there's like an exception carved out for like uh, um, investors that are like build to rent like huge development things, right? Because we know we're seeing a lot of that here, Central New York. So that's obviously still a thing going on. Um, but the bill is meant to tackle the housing supply directly, right? So all of these new HUD guidelines for all of these regulations, local government things. Basically, it's the entire bill is designed to make local governments more efficient and less stringent on some of their regulations so that the people out there that can build homes are able to do it quicker and with more access and more options as well. It expanded a lot of other already existing programs. The rental rental assistance demonstration program, CAB, a lot of things. If you want to hear a truncated list, you go back to that episode. I went through quite a bit, but that wasn't even barely touching the surface of everything in there. So really, what this means is especially for communities like us, but really people overall. If you're competing with corporate institutional buyers or things like that for these starter homes, which is it's a two sides to that conversation, right? A lot of people say that that really isn't it's not as prevalent as people's making it seem. And then on the other side of people saying that the statutes in this law um doesn't really probably there's room for loopholes basically for these the institutional buyers to get around that. But I guess and nothing in the bill is going to happen immediately. There won't be some overnight thing to where there's suddenly 100 million new houses on the market, right? So, this is something that's going to take time. It's going to be something that we're going to have to, monitor and see, over the next coming years how it's going to play out. But really, it is significant, especially for places like Central New York, where we have huge economic development happening, and really that's competing with the housing crisis that we were already experiencing. So, and that's not just us, that's happening a lot of places all over the country. Um, so those are your updates. I'm glad I hit the point that you were talking about. That means that
Yes, thank you.
I did my job. Um, but as with everything else that we speak on, if there is something that yeah, that you're concerned about, something that we spoke about that hit home with you, or as I always say, if you want to get your finances in order so that you are more prepared for whatever is to come, then please give your friendly neighborhood advisor a call at 315-748-5540. Again, that's 315-748-5540, or you can send me an email at michael.jennings@brackensfsn.com.
Mike Jennings is a wealth advisor of Brackens Financial Solutions Network, LLC, and a registered representative of LPL Financial, member SIPC. He is your friendly neighborhood advisor.